There are trillions of dollars in high-yield debt, so-called junk bonds, that are in income ETFs owned by middle America. People that were attracted to yields with no understanding of the risk. The problem with that is that the ETFs are extremely liquid. They trade like water. You can get into them, you can get out of them. But the underlying assets are extremely illiquid. If middle America begins to have a concern with credit quality, I'm not saying they will, but if they do, and they begin to sell these ETFs, the ETFs must sell the underlying bonds to raise the money for redemptions, and the underlying bonds are very illiquid. This potentially is a run on a bank with no Fed to save anybody. And if I had to think about something that scares me, that's it.
Rick Rule warns of a looming financial catastrophe that could bankrupt every bank in America. He explains that if middle America begins to worry about credit quality and starts selling off their high-yield debt ETFs, the underlying illiquid bonds would need to be sold to meet redemptions. This scenario could trigger a devastating run on the banks, with no Federal Reserve intervention to save them. The collapse of these institutions would send shockwaves through the entire US economy, leading to widespread insolvency and unprecedented financial chaos. With trillions of dollars tied up in these so-called junk bonds, the risk is enormous. Rule highlights the fragile state of the banking sector, which is already grappling with over-leveraged balance sheets and massive derivative exposures. The potential for a complete financial meltdown is real, and understanding this risk is crucial for anyone invested in the current market.
People need to know that the economy is working more for people like me than it is for many other people. The low interest rates, low by historical standards, which we still enjoy although they're up, benefit people like me with access to credit and the knowledge as to how to use credit. For people who either don't have access to credit or have the knowledge to use credit, the inflation that we're facing now is a real problem. The second thing is that this is a skills-based economy. There are people in this economy, unfortunately, that don't have the skills necessary to deliver utility to others, and so their incomes are faltering, while the incomes of people who do have marketable skills are really keeping pace. So it's important to note that the economy is really, truly bifurcated in a very ugly way, and I'm cognizant of the fact that when I talk about economic strength, I'm talking about statistical strength. There are millions of people who are struggling. I disagree with her, first of all, but that's why I asked her. That's the beauty of what she says. Remember, too, that before I get into the question, that Nomi's background as an analyst on Wall Street is particularly useful answering that question. She doesn't come from academia. She doesn't come from government. She comes from the belly of the beast. She comes from Goldman Sachs. And the fact that she's concerned about the prevalence of commercial real estate loans, particularly on the larger community banks, is particularly instructive. I, like everybody else, have been watching sites like TripleNet, where they talk about trophy buildings that were $700 million buildings, clearing the market at $125 million. And the impact that must be having on whoever the first lien holder was is really, truly ugly. She suggests that the eye of that storm will be upon us in 2025. So it'll be interesting to see how those banks weather the storm. I would ask your listeners to concern themselves with something else too. And I think you and I have talked about this in prior interviews, which is high-yield debt. There are trillions of dollars in high-yield debt, so-called junk bonds, that are in income ETFs owned by middle America. People that were attracted to yields with no understanding of the risk. The problem with that is that the ETFs are extremely liquid. They trade like water. You can get into them, you can get out of them. But the underlying assets are extremely illiquid. If middle America begins to have a concern with credit quality, I'm not saying they will, but if they do, and they begin to sell these ETFs, the ETFs must sell the underlying bonds to raise the money for redemptions, and the underlying bonds are very illiquid. This potentially is a run on a bank with no Fed to save anybody. And if I had to think about something that scares me, that's it. I don't think we face a recession this year. I think there's still too much optimism on Wall Street. I think there's still too much liquidity among the class that's still capable of investing. I would have expected, had you asked me the question in 2022, I would have said in 2024, we're almost certain to have a recession. Mercifully for me, I was wrong. I'm always afraid. The nature of somebody like me, who is a lender at heart, is that you are always cautious. You're always concerned. So while I'm not an economist, it's been a very long time, Charlotte, since we had a recession. That doesn't mean we have to have one. But I'm concerned about the impact of the economy on those people who don't have the earnings capability that I have, and how that might be reflected in the economy in 2025. What I guess I would say to investors is begin to expect a recession and hope you're wrong. The traditional response to gold in a recession, if the recession is accompanied by a liquidity squeeze, is that the price goes lower to begin with. In a liquidity squeeze, the sell decision isn't made by the investor, it's made by the margin clerk, and that's usually a pretty cold calculated sell. What happens after that is really a function of how the Fed responds to a recession. If they respond to a recession by lowering the nominal interest rate, by quantitative easing, the same way that they responded to the recession in 1975, what happens is that precious metals markets go berserk. So if we have a circumstance where we have an inflationary recession, stagflation, and where the Fed's response is a political response, which is to say to make credit easy, then all bets are off for precious metals and precious metals related assets to the upside. I'm not a conspiracy theorist. I don't think that the central banks have the capacity to work together. I think that they're instruments individually of their country's own political superstructure. So I'm not particularly concerned about that. I am concerned about higher for longer. I am concerned, well, let me rephrase that. I actually hope that the gold price doesn't rise precipitously, because if it rises precipitously, it's a function of a very, very bad economy. I would prefer to be wrong about the price of gold and have a nice life. But if we're talking from the point of view of a gold bug, to the extent that this economy was able to muddle through, as an example, without an interest rate cut, to the extent, and I don't think this will happen, that we are able to grow our way out of debt and deficits in the US dollar without quantitative easing, that would be very bad for gold. Gold does well during times when people are concerned about the maintenance of purchasing power of their savings in fiat-denominated assets. If those fears turned out to be ill-founded, then gold would do poorly. I don't believe that's the circumstance that we face, sadly. I wish it were.
Okay, so that's your potential gold negative scenario there.
My gold scenario is, what if gold really is a pet rock? What if it doesn't matter? What if there are other instruments that people can use? What if the economy is diverse and advanced enough that one could maintain their purchasing power by the fractional ownership of businesses, say shares, in companies that had pricing power? I don't consider that to be the case either, but in terms of answering my own question, that would be my fear. And I tried to pin the guy down from the World Gold Council in terms of time. You may have heard me say I'm 71. Will this occur in my lifetime? The World Gold Council, representing the gold industry, and the LBMA, the London Bullion Market Association, is cooperating right now on the digitization of gold. The digitization of gold that would be the result of cooperation between the LBMA and the World Gold Council would enable ultimately the development of one or more gold tokens representing deposit receipts around gold and redeemable for gold. And I need to say not if, when that occurs, because it will occur, it will allow for gold to become money again. You will be able to, with real gold that you can trust, non-fractional reserve gold, but real gold, you'll be able to go to Starbucks and buy a cup of coffee with a fraction of a gram. You will be able to, if you want, redeem those tokens for physical gold. There will be a fee associated with that, but you will be able to save in gold, you'll be able to borrow against gold, you'll be able to invest in gold, you'll be able to transact in gold, and you'll be able to do that with very, very, very low transfer costs. I'm going to go out on a limb and say that it will happen within the balance of this decade, which is to say the next 5 or 6 years. I'm 71. I was trying to pin down Joe as to when it will take place, will it occur in my lifetime. I suspect it'll occur in my 70s, and I'm 71.